everyone. We're going to be doing problem 5-7 today, and it's a full consolidation problem from start to finish. So I'm going to go through all 7 steps with it. To start out, have a look at your notes, because there are a couple of things that we want to bring your attention to with the problem. First of all, we say ignore the information about the price of Lee's share as at the purchase date, and a worksheet is provided, so make sure you have that worksheet as we go through this problem, or a copy of it. Okay, it is actually down on the following page, page 17 of your notes. Okay, and there's just a note that distribution expense has been renamed to depreciation. All right, so have a look at the problem. If you need to, pause here and turn to it in your textbook. It is on page 306. You will notice as you read it that this appears to be an author who likes American history, and apparently since Grant won the war, Grant gets to buy Lee in this consolidation. So when you're reading a problem for consolidations, the problems tend to be long and there is a lot of information in them. So when I look at a problem, I always try and break it up into 3 time periods. You want to be cognizant of 3 time periods whenever you're reading through. So the first time period that you're going to want to be cognizant of is when did the purchase happen. Step 1, which is the acquisition differential table, always happens as of the purchase date, using the purchase information. So consequently, you want to always be cognizant of when was this company purchased. So the purchase is January 1st, year 4 then. They bought 80% of Lee Company for $70,000 cash. Of course, the other pieces of information that we need there is the retained earnings and common shares. And of course, we need the fair value differences at the acquisition date. So that first paragraph, and you'll find this with most problems, is really about what happened at acquisition. Then what we need to do is we need to figure out when we're consolidating as of. So you'll notice that it asks us when we do the consolidation, it's giving us information as at December 31st, year 7. So that's going to be our consolidation date now. So what that means is that we have, and this is the 3rd time period, the years that are intervening. So we've got an acquisition date of January 1st, year 4, a consolidation date of December 31st, year 7. So what that means is we have year 4, 5, and 6 as intervening years, okay, or prior years. So we always want to be cognizant of that. So this information then here, okay, gives us the intervening and the consolidation year information. Okay, talks about the patent had a useful life of 5 years. We'll need that for step 2 for our AD amortization schedule. And the entire inventory was sold during year 4. You would actually assume that even if you were not told that. We also see that the recoverable amount for goodwill was determined to be $10,000 on December 31st, year 7. So what that means is that we may have likely an impairment loss in year 7. Okay, there's this accounts receivable here. That's an intercompany transaction. We're going to use that in step 3. Okay, so that's my pieces of information. It's helpful to break them into the time periods, but also think about where we're going to use it, in which step. Okay, all right, so let's start on the actual steps in the consolidation. Okay, so let's get started then. So it's nice to get a little bit of information down when you're doing a problem, I find, so you don't lose track of it. So the acquirer is Grant. The purchase date is January 1, year 4. The consolidation date is actually December 31st, year 7. So what that means is this is my consolidation year, and my intervening years or prior periods are going to be years 4, 5, and 6. Okay? Just makes me clear on the problem when I have that information down. All right, so let's get started on step 1. This should be the step that you're most familiar with. This is the AD table. So remember, in the AD table, what we're really doing is taking our purchase price, or in this case it's going to be our implied value, we're allocating it to the book value of the subs net assets at acquisition, then to the fair value differences, and finally determining goodwill. So in our AD table then, our purchase price is always our starting point, and it was $70,000. In this particular case, for our implied value, if you go back to the problem, we're told that Grant purchased 80% of Lee, so we're going to divide by 80%. That's going to give me an implied value for this company of $87,500. Recall in the problem that there's a piece of information here. Lee's shares were trading for $7 per share on the date of acquisition. We're actually just ignoring that piece of information and using extrapolation to come up with the implied value. All right, so next, allocate to the book value of the subs net assets. And remember, the subs net assets are really the assets minus the liabilities. But the shortcut to getting that is just to take the common shares and the retained earnings at the time of acquisition. So we're told in the problem that Lee had 25,000 of common shares outstanding, 30,000 in retained earnings. So common shares of 25, retained earnings of 30,000, give us 55,000. Remember, even though equity is a credit, when we refer to the subs net assets, because we're referring to assets minus liabilities, we actually consider it to be in a debit position. So consequently, this total, the subs net assets, are 55,000 in a debit position. And so that's going to give us an acquisition differential of 32,500. Remember, the AD is really just the amount we paid in excess of the book value of the subs net assets, i.e., it's the amount we paid in excess of what the balance sheet of the subsidiary at that time would have valued it at. And of course, there's two reasons we would do that. One is because the fair value of some of the assets and liabilities may be greater. And the second is, of course, goodwill. So our next step is to figure out our fair value differences or fair value differentials. And so we're just going to take the fair value minus the book value, and that's going to equal my difference. Just have to squeeze the item in here. All right, so if we go back to the problem then, inventory had a fair value of 55 and a carrying amount of 50. So there's one of our fair value differences. So what that means is, of course, remember, when we consolidate, we want to record the subs assets and liabilities at fair value at acquisition. So consequently, we're going to have to debit inventory for 5,000 if we were consolidating at acquisition. The second fair value differential is the patent. The patent had a fair value of 20,000 and a book value of 10. So we have a patent, the fair value of 20, a book value of 10. So if we were consolidating at acquisition, that would require a $10,000 debit, once again to bump it up from book value to fair value. Those two added together are $15,000. Remember, here we always subtract and here we always subtract. Okay, so we're subtracting 15,000 from 32,500, which will give us 17,500 in a debit position. That's our goodwill at acquisition. Okay, so that is step one, our acquisition differential table. Step two now. Recall that similar to significant influence, what happens is because when we consolidate, we have in fact changed the asset values of the inventory and the patent on our consolidated books and records. We bump them to fair value. So the issue becomes then, if we bump them to fair value, then when that inventory is sold, cost of goods sold has to reflect our fair value. The sub, of course, will have actually determined cost of goods sold based on 50,000. Okay, that was their book value. However, when that inventory is sold, from our perspective, in the consolidated statements, because we've recorded the inventory at 55, that's going to mean that in fact cost of goods sold for that inventory needs to be 55,000. Okay, which means we're going to then have to adjust cost of goods sold by that $5,000. Same with actual amortization of the patent, the intangible asset. The intangible asset is recorded on the subs, books, and records at at 10,000. When we consolidate, we of course are in fact considering that patent to be valued at 20,000. This patent is being amortized in the subs, books, and records. But the problem that's going to occur is the sub is going to be amortizing based on that 10,000. So consequently, we have to adjust amortization expense to reflect the fact that in fact that patent is valued at 20,000. So that's what step two is about. It is our AD amortization schedule. And all it is designed to do is to show the changes to that acquisition differential over time. Okay? So we're showing the changes to that acquisition differential over time. So when we start this out, once again going to put each item, we're going to put the fair value difference at acquisition. So this is at January 1, year 4. So for each item, there's the inventory. We're copying from above, which was in a 5,000. The fair value difference is a 5,000 debit. We have the patent, which was a $10,000 debit, and of course we have the goodwill, which was sitting at 17,500, a debit position. That adds up to our acquisition differential of 32,500. So now we have to account for the years in between. And I'm just going to put years 4, 5, 6 all together here. Okay? And then our current year is year 7. Remember, these two columns here, this shows what's going through the current year's income statement. This column here is actually showing what's gone through past years' consolidated income statements. Because remember, we would have consolidated this in years 4, 5, and 6, right? So it's showing what's going through past years' income statements. Of course, the sub, though, won't actually have made those adjustments in their own books and records. So consequently, every year we have to update what we've done in the past, except what we put through the income statement in years 4, 5, and 6 now has to go through retained earnings. So any adjustments we did to the AD in the past will go through retained earnings this year. Hence why I've colored it pink there. Okay, so the inventory would have been sold in year 4 in its entirety. So that would have meant there would have been a $5,000 debit to cost of goods sold that year. The patent, if you go back to the problem, we see that the patent had a useful life of 5 years. So what that means is we need to take this $10,000 debit, divide by 5, and every year we need to adjust our amortization by $2,000. Now, what will have happened in years 4, 5, and 6? In each of those years, we will have adjusted it by $2,000. So the cumulative effect for years 4, 5, and 6 will be a $6,000 debit. $2,000 a year will have gone through the income statement, which means $6,000 now has to be adjusted to retained earnings. During the intervening years, there was no goodwill impairment or anything of that nature. So now let's move on to year 7. Year 7, there is no change to the inventory, of course, because it's already sold. So our U7 UAD for the inventory then is also essentially now going to be 0, right? We're not going to adjust the inventory. This is, of course, the UAD is what we're going to actually adjust on the balance sheet. Okay? It's what we're actually going to adjust on the balance sheet. Well, since that inventory is long sold, there is no reason to adjust the balance sheet anymore, right? It's gone. All right, so the patent, in our income statement this year, we will once again have to do that $2,000 debit to amortization expense. Because our fair value, okay, here is greater than our book value of, our fair value of 20 is greater than our book value of 10, each year the sub is taking less amortization than what we need to have on the consolidated statements. So consequently, we have to debit amortization expense for $2,000 each year to bring amortization expense up as well. So keep in mind with this particular schedule, you always are subtracting across. So 10,000 minus 6,000 minus 2,000 means that all we have left to put on our balance sheet is a $2,000 adjustment to the patent. Remember, what's happening is the patent has a 5-year life. We have to amortize it for 5 years in the consolidated statements, just as the sub is amortizing it for 5 years as well. So we're going to amortize that fair value difference for 5 years. After that, the patent will be fully amortized. Assumably at that point, they're going to retire it or sell it or something of that nature. So goodwill is interesting. Goodwill, we're told in the problem that for goodwill, we remember, where is it here? Oh, the recoverable amount for goodwill was determined to be $10,000 on December 31st, year 7. So what that ends up meaning then is this number, what we're going to adjust goodwill to on the balance sheet is only going to be 10. But that means we have to record a loss here of $7,500. Okay, a loss will essentially be a debit. So now if we add this up, we have $11,000 in debits that need to go through retained earnings. Remember, we're doing this now the direct method using calculations. So consequently, when we, in step 6, calculate the sub's adjusted opening retained earnings, we will use that $11,000 debit there in step 6. Okay, so we label it SOAR for the sub's opening retained earnings when we adjust it. These two items have to go through our current year's income statement. Okay, they have to go through the consolidated income statement. And the net effect on our income statement of those is a $9,500 debit. Now, remember, when we calculate INCI, we're going to actually need to use that figure. We're also going to use that figure when we calculate consolidated net income. And here's the reason why. When we calculate INCI, it is the NCI portion of the sub's income. But it has to be the adjusted net income on the consolidated financials. And of course, we're adjusting net income for those two items. So consequently, we're going to put this in green and label it SANI. Whenever we are calculating the sub's adjusted net income, which we will use, as I said, for INCI and consolidated net income, we're going to have to use that adjustment there. Okay? Then finally, these are our balance sheet adjustments. They will have to, in fact, occur on our balance sheet. This will be a debit. This will be a debit. All right. That is a $12,000 total effect on our balance sheet. That's the net effect on our balance sheet. And we will actually need to use that for BNCI. BNCI, of course, is the NCI portion of the sub's equity or the sub's net assets. So what happens is we use the adjusted net assets for that. So we need to make that adjustment when we do our BNCI calculation. Okay, so that is essentially step 2. Step 3, we look for intercompany transactions. This is fairly easy at this point in time because we only have a few intercompany transactions that we're dealing with. One, of course, is dividends. So we're always going to be on the lookout for dividends. In this particular case, there is none. What a nice, easy problem. Okay, there are no dividends. Perfect. All right, so the only other thing, some other things that we would look for is there in fact accumulated depreciation at acquisition we should get rid of? We'd have to be told that in the problem. We're not told that in this problem, so we don't have to worry about it. And just a note on that, when we did our AD amortization schedule, one of the things you should look at all of the time is your balance sheet. Have a look at the balance sheet for this company quickly. Notice that the equipment and the patent are both recorded net. Okay, so consequently, we don't have to have a separate accumulated amortization account. But if in fact we did have a separate accumulated amortization account, we would have to do a separate account there. Now, one of the things you may or may not be aware of, because I know we don't emphasize it in intermediate, PP&E normally we report a separate accumulated amortization account, okay? Some financial statements for consolidation purposes, you'll see it reported net, similar to what it is on this one, where they have equipment at net. But and we just do that to make it simpler for you, okay? Patents, though, and patents and intangible assets are actually normally reported net. Okay, we normally don't report a separate accumulated amortization account for them. So you'll notice that when what we're amortizing is patents and such, we don't normally have or other intangibles such as trademarks, we don't normally have a separate account for them. All right, so we have no dividends in this problem. However, there is an intercompany payable and receivable. We're told that here. Grants accounts receivable contains $30,000 owing from Lee. So we're going to have to eliminate that. And that's fairly easy. What we're going to do to eliminate, remember, elimination entries always go backwards of what the normal entry would be. So you have to kind of get used to that. So we're going to credit accounts receivable, in this case for $30,000, and we're going to debit accounts payable for $30,000. And those are both going to have to happen on our balance sheet, so we're going to color them blue. On to step 4. Now we're into the calculations. What I recommend you do with the calculations is this. Each time you do a consolidation, try and memorize another one. Start with INCI and BNCI. They're usually the easiest. Okay? Don't feel like you have to memorize it all at once though. See if the next consolidation you do, you can do INCI and BNCI without looking at your paper or without looking at your notes. Then move on and try and do consolidated net income. Okay? They're difficult to memorize all at once. So step 4 is INCI and BNCI. So for INCI, we're going to take basically the subs net income. And think about what INCI is. INCI is the non-controlling interest portion of the income statement. Okay, we're figuring out the non-controlling interest portion of the income statement. It's the income statement, so it's got to start with the subs net income. We're going to have the adjustments to it, so we're actually going to get to SANI, the subs adjusted net income. It's the NCI, so we're going to take the NCI portion of it. Okay, if you think it through, the calculation makes sense. So we're going to take the subs net income. In this particular case, if you look at your worksheet, the subs net income in the current year, remember all of this now is happening as of the current year, the subs net income is $23,000. So I'm going to put that $23,000 in brackets because it represents a credit. It's net income. Then we're going to adjust it for our SANI adjustment. So we're going to take current year's AD amortization. And keep in mind, we could actually put both of these adjustments through separately. The only reason we total it here and label it SANI is it just makes it easier than putting every adjustment through separately. So, current year's amortization of the AD was $9,500 debit. This is going to give me then the subs adjusted net income, which I explained in class is really subs net income with adjustments to it. Okay, pretty straightforward. Subs adjusted net income is $13,500. We're going to take the NCI percentage, okay, because we're calculating this for the NCI portion. So 20%. So that means INCI, which is what we're going to report for NCI on the income statement, they're essentially getting $2,700 of the net income allocated to them. So of the subs, $23,000 in total net income. We're going to have adjustments to it of $9,500, and then basically the non-controlling interest portion is going to end up being $2,700. Remember, we have to flip the sign, because if you remember from class, the actual entry for INCI and BNCI when we did our first consolidation with entries was a debit to INCI and a credit to BNCI. This should make sense to you, because what we're doing is we've got subs adjusted net income of $13,500. We're allocating $2,700 out. Okay, so it becomes a debit, in a sense, to our net income, a debit entry, almost like an expense. Okay, and that's the allocation to INCI. We debit INCI, credit BNCI. So now BNCI. BNCI is basically the non-controlling interest portion of the subs net assets, right? i.e., it's the part of the balance sheet that we're allocating to the non-controlling interest and saying, okay, reality is we've consolidated 100% of the balance sheet, but we really only owe 80%. So this is the 20% that we're allocating of the balance sheet to those non-controlling shareholders. Remember, I showed you the Canadian Tire statements, which show the NCI on the income statement, the portion of income that got allocated to the non-controlling shareholders, and the NCI on the balance sheet. the portion of the balance sheet that got allocated to the non-controlling shareholders. So BNCI, again, is really assets minus liabilities because it's the subs net assets, but we can use common shares and retained earnings for that. So we're taking the subs net assets and we'll take common shares and retained earnings. And remember, this is always done with the current common shares and retained earnings. Okay? So what you're going to do, where you're going to get this from, is you're going to get this from the worksheet. Okay, so if I scroll up to my worksheet, okay, closing retained earnings is 65, common stock is 25. So that's in fact what I'm using. Always remember that BNCI, the NCI is getting a portion of the current year's net assets, okay, not just the acquisition. So common shares we said were 25,000. Retained earnings we said were 65,000. Then we have to adjust it once again for the AD. Okay, and in this case we're adjusting it for the UAD, i.e. this is our adjustments that we're doing to the consolidated balance sheet, right? So once again, we could in fact use both the 2,000 and the 10,000, but it's just easier if we total them and put 12,000 in total adjustments through our BNCI calculation. Okay, so there's our 12,000. These are all considered to be debits. So consequently, now we have Santa equal to 102,000 in a debit position. We multiply by the NCI percent of 20%, and that gives us BNCI. Multiply that out, should give us BNCI of 24,400. And remember, once again, we're going to flip the sign to a credit. Okay, when we set up our original BNCI, it was a credit to it. When we set up our INCI, it was a debit to INCI, credit to BNCI. This ends up being normally a credit. So this will go on our balance sheet, of course, as an adjustment. We'll put it in the equity section. This will go on our income statement as an adjustment. We'll put it after the entire entity net income. We take that net income and break it up into the NCI portion and the parent portion, which we just call the consolidated portion. All right, so step 5, consolidated net income. This is just a check figure. It's really helpful to have. Also, you could be asked just to calculate it on an exam, so you want to know how to do it. But when we're consolidating, we consolidate the income statement first, so it's helpful to know what consolidated net income should be, and we figure this out by calculation as well. And remember, it's essentially equal to the parent's adjusted net income, which at this point the only thing we would adjust it for is dividends, and the subs adjusted net income. And we take the parent portion of it. So we take the parent portion of Sanny, and we take all, of course, of Panny. And of course, the subs adjusted net income gets adjusted for current year's AD amortization. Okay? We're basically adding those two together to get consolidated net income. So first of all, we take the parent's net income. The parent's net income in this particular case, if you go back to your textbook or to the worksheet that you have, the parent's net income for the year is $230,000, of course in a net income, so credit position. Normally we would have a dividend adjustment, which we would have considered in step 3 in order to be used in this step, but there is none. So consequently, Panny is in fact equal to $230,000 in a credit position. So next up is Sanny. the subs adjusted net income. Remember though, we already calculated SANI up here. We took the subs net income, adjusted it for current year's amortization of the AD, which gave us $13,500 in a credit position. We're going to continue to use that number. There's no sense calculating it twice. So we're going to take SANI of $13,500 in a credit position. We're going to multiply it by the parent's portion, which in fact is 80%. And that is going to give us $10,800 in a credit position for SANI, okay, for the parent's portion of SANI. We add those two together and we have consolidated net income $240,800 in a credit position. Recall that this is a check figure only, so we're going to use it when we consolidate. And finally, step 6, last step before consolidation. If you recall, when we consolidated at acquisition, we eliminated the subs retained earnings. Now what has to happen though is we actually get to share in some of the retained earnings, but only since acquisition. So the parent we have to figure out what the parent portion is of the subs retained earnings. Okay, essentially in this particular calculation. We need to figure out how much of the subs retained earnings we share in, how much we're actually going to eliminate. So we still don't share in any of the retained earnings prior to acquisition. So to figure out consolidated opening retained earnings, and the reason we calculate opening retained earnings and eliminate a portion of it is this. What's going into closing retained earnings is in fact the current year's adjusted net income. Well, we've already figured that out, right? We've already figured out the INCI portion of it. So consequently, all we have to worry about eliminating is in fact the current year's opening retained earnings. All right, so it is going to include the retained earnings of the parent, which is Grant in this case. So Grant's retained earnings, and if you look at the balance sheet on page 307, you can use that, or you can always use your worksheet. There's their opening retained earnings for the parent. There's the opening retained earnings for the sub. Okay, so retained earnings of the parent we saw on the worksheet was $70,000 in a credit position. So next thing, figure out what is our percentage of the subs, or what is our portion of the subs retained earnings going to be. So we start with the retaining earnings of the sub currently. Their current retained earnings is $42,000 in a credit position. Remember how we eliminated the subs retained earnings at acquisition? Well, we essentially have to do that now. So what we do is we go less the retained earnings at acquisition. The retained earnings at acquisition, you can get this off of your original AD table, was $30,000 in a credit position. So that means the increase in retained earnings since acquisition is a $12,000 credit. Okay? Now, what we have to adjust that for is any prior year's AD amortization. Remember how I said this figure up here, these adjustments now need to go through retained earnings, right? Well, because we're doing retained earnings by calculation, we could in fact debit retained earnings individually for each of those. We could debit opening retained earnings for each of those individually. But it's easier to just figure out one elimination. So if you think about it, we could debit it for 5, debit it for 6. We could debit it, in fact, for this 30, this retained earnings at acquisition. Okay? We could go through and do those each individually. However, it's just easier to figure out by calculation all of those adjustments that are going to happen to retained earnings and do them as one elimination instead of several. So prior year's AD amortization in total then was $11,000 debit. So that really means our equity pickup, okay, the amount of equity that we can share in is really only $1,000 since acquisition. Okay, it's $1,000 credit position, so we can only really share in that $1,000. So now we're going to take the parent percentage of 80%, and that's going to give us an $800 credit. So, consolidated opening retained earnings is $70,800 in a credit position. Okay. And what is our adjustment going to be? Well, current opening retained earnings, if we compare the two, current opening retained earnings, well, we said it was $70,000 for the parent, $42,000 for the sub, so that's equal to $112,000 in a credit position. Well, to get $112,000 to $70,800, we're essentially, our elimination entry now is going to be a $41,200 debit. Okay? It's going to be a $41,200 debit that we're going to do to opening retained earnings to eliminate it. And I'm going to put that in pink as well. This is going to go to opening retained earnings. Okay? All right. Okay, so as we start our going through and doing our entries, the first thing that we have to do is we need to, in fact, get rid of two things. We always have to get rid of the investment account, and we always have to get rid of the subs common shares. Okay? Because notice, in all of our calculations that we did, at no point do we take those two into consideration. And if you think back to the elimination entries we did, okay, that was part of the first elimination entry. The elimination entry, if you recall, affected the investment account, common shares, retained earnings of the sub, and BNCI. Well, BNCI we've calculated. That's good. Retained earnings now. We've calculated opening retained earnings. That's good. But what we haven't ever done is considered that common share and investment account entry. So we do still have to do that. So on our balance sheet here, the investment in Lee, we need to essentially get rid of that. That would be a credit to do so. And I'm just going to put brackets around. Remember, brackets now indicate that I'm subtracting. This is a debit. So consequently, we're going to have to get rid of it. We're eliminating it, so we're going to have to credit it. We need to have that $25,000 disappear. Okay, this is a credit. So $25,000, we would debit it to make it disappear. And those brackets indicate we're subtracting it now. Remember, in the steps that we do, brackets indicate credits. Positives indicate debits. But when we get into this schedule, we're just putting credit and debit beside, and I use brackets to indicate subtraction. As I indicated in class, you can do it however works for you. All right, so now what we're going to do is we are just going to work down the schedules, the steps that we've done. So I have the steps beside me. I'm not going to keep scrolling up and down because that would get tedious for you. So I have the steps beside me, and you should have your steps as well. And all you're looking for is yellow, blue, and pink, where we're actually adjusting the retained earnings statement. Okay. So first thing I see under step 2, you should have step 2 in front of you, is we need a $2,000 debit to the income statement for the patent depreciation. So depreciation expense looks like a good place to do that. So I'm going to debit it for $2,000. Okay. Then goodwill had a $7,500 impairment loss. Normally we disclose that separately, so I'm going to put the impairment loss there and a $7,500 debit to it. All right, next up, the blue in step 2. The blue are our balance sheet adjustments. For our balance sheet adjustments, we of course have the patent. So what these adjustments are is these adjustments are what's left of our fair value differentials from acquisition. Okay, after we've amortized them, these are the fair value bumps that we're doing based on what's left. So the patent, we have to debit it for $2,000, and we need to set up goodwill. But because of the impairment loss, remember in the past, years 4, 5, and 6, we would have set that goodwill up at $17,500, its original amount. But because of the impairment loss in this year, we're only setting the goodwill up now for $10,000. Okay? So now we move on to step 3. In step 3, we said we're going to have to credit accounts receivable for $30,000. This is a credit and debit country, so it's going to end up being subtracted, right? Because this is, of course, in a debit position. And we said we had to debit accounts payable for $30,000 to eliminate $30,000 of the accounts payable. Now this is a debit and credit country, so it's going to end up being subtracted. Next, step 4, we have to record our INCI. So we're just going to take this line right here and put our INCI on it. Okay, so INCI is a $2,700 debit. BNCI will go on our balance sheet. We throw it somewhere in the equity section. Let's put it there. BNCI is a $20,400 credit. All right. Consolidated net income, we will use that in a second. Our elimination, our opening retained earnings, we said we have to eliminate now $41,200. So we're going to debit it, and of course opening retained earnings is in a credit position, so debiting it will eliminate a portion. We subtract it. All right, let's go through and consolidate now. What I suggest you do actually is try consolidating it now on your own, and then you can turn me back on to see how I've gone through and done it. So for sales, we're just adding them together, and we get total sales of $1,260,000. Cost of goods sold, no adjustments to that, so we're just adding it together, and it's $580,000. So our gross margin, okay, that's a subtotal, so we don't add it across. Instead, we'll take the $1,260 minus the $580 is equal to $680,000. All right. Next, we have our depreciation expense. Remember, depreciation, it's an expense, so it's a debit. So we have $30,000 plus $25,000 plus $2,000. That's going to give us total depreciation expense of $57,000. Other expenses, no adjustments to that, $236,000. Income tax expense, no adjustments to that, $136,000. And finally, our impairment loss is $7,500. So what we want to do next is find our net income for the entity. This is our not our consolidated. It's our net income that includes the NCI portion. So before we take out the NCI, if you add those up, okay, or actually take the 680 minus the 57 minus the 236 minus the 136 and the 7,500, you should then get net income for the entity You should then get net income for the entity of $243,500. Then we have this INCI is a $700 debit that will come out of it. Remember, this is technically now in a credit position. This is in a debit position. So the portion of net income that goes to the INCI is $2,700, which means what's left over for consolidated net income is in fact $240,800. All right, now remember this $240,800 has to go here in my statement of retained earnings. Oops, except on the line below. So my opening retained earnings, 70 plus 42 minus the 41.2 should give us 70,800, okay, which is the amount we figured out to be consolidated opening retained earnings. We have no dividends, so it's just the 70,800 plus the 240,800. That gives us closing retained earnings now of 311,600. Okay? Cash. Now, remember this 311,600 needs to come down here. Okay? So we always, when we consolidate, go in order of income statement. Net income goes into the retained earnings statement. We do the retained earnings. Closing retained earnings goes to our balance sheet, just like we would normally do financial statements. So we have cash, 23,000. Accounts receivable, we have 185 plus 82 minus 30, so 237,000 in accounts receivable. Inventory should be 410, no adjustments to it. Remember, we have no adjustments to inventory because that inventory has long been sold back in year 4, and we're doing this in year 7. The investment account has, of course, been eliminated. Equipment, we had no equipment differences, so it's 435,000. We have the patent, which is now sitting at 4,000. And we have goodwill at 10,000. Add those up, and that gives us our total consolidated assets of 1,119,000. All right. Looking now at the payables and equity side, accounts payable is 355,000. And other accrued liabilities is 110,000. And income taxes payable is 152,000. Okay? So we're just adding across, except of course for the accounts payable where we have to take out the 30,000 debit. BNCI is 20,400. And finally, common stock, all that's left is the parents at 170,000. That should add up to 1,119,000. Okay? Oh, so we've consolidated, we're happy with it, and we balance. So we get to draw a little happy face, and we get to play our happy song. Yes, people, it is magic. The consolidation works. All right, thank you. Have a good day.